Okay, I'm watching a video where the person is suggesting that maybe a 401k isn't right for you. Oh, so much bad advice. Well, enough of that. Stay tuned, everyone. Understanding your 401k and avoiding bad internet advice coming up. Hey everyone, it's Jeff Drayton, Certified Financial Planner Professional and founder of Jeffrey A. Drayton Financial Planning and Wealth Management, LLC. So today's video is going to be in a few parts. Maybe I'll do this as a series of videos. But here, I'm just going to focus on understanding a few basics about your 401k and why, yes, you probably should be participating. As a matter of fact, for the vast majority of people, any video that suggests that maybe a 401k isn't right for you or that they have the truth about the 401k is likely giving bad advice. Why? Well, for several reasons. But for the sake of time, in this video, I'm going to focus on 3 as to why, yes, you probably should be participating in your company's 401k plan. Truthfully, I feel so strongly that this is such a standard piece of good advice that for me, it would be an immediate red flag should any financial advisor tell me not to. Does that mean that there could never be some such unique set of circumstances that would make contributing to your 401k not your best option? Of course not. In financial planning, never say never. But the fact is, those circumstances would be unique, and therefore my advisor would really have to have a set of compelling reasons why he or she is advising not to. Again, for most people, your 401k is a wise option. So here we go. Why is it that contributing to your 401k is such a good idea? Well, reason number 1 is matching contributions. Hands down, this is something you absolutely want to be taking advantage of. I think most people have at least a vague understanding about how matching contributions work. However, in my experience, there are a number of details that often get missed. So first up, let's just start with what we think we know. Generally, if you make contributions to your company's 401k plan, your employer will also make contributions in what is commonly referred to as a match. How much will that match be? Well, that depends on your company and whatever it is that is the matching formula for their 401k. But what might be a typical example? Well, typically they will have a formula that will give 2 percentages. The first is the percentage of your contribution that they will match, and the second is the limit as to how much they will match each year. That second one will likely be a percentage of your income. So here's an example. Your company might say that their 401k match is 100% of your contribution up to a maximum of 4% of your salary. So how does that work? Well, every paycheck in which you elect to make a contribution to your 401k, your employer will match that contribution dollar for dollar, 100%. However, once their contributions for that year have reached an amount equal to 4% of your salary, that's it. They're done. They're not going to contribute anything more. Now, there are lots of 401k matching formulas, some more complicated than others, and there are even some companies that make what are called non-contributory matches. This simply means that they are going to put money into your 401k whether you make a contribution or not. That sounds great, but the downside is that typically non-contributory contribution formulas aren't as generous as those formulas provided in 401ks that require you to make a contribution first. Here is one very good piece of advice. If you do not understand your company's 401k matching formula or simply have no idea if they have one, speak to someone in your benefits department and find out, at very least, do they provide a match, and if yes, what is the amount you need to contribute to get the maximum match from your company? Your goal at a minimum is to contribute at least that. In my business, we look at this as basically free money, dollars that you will not get if you choose not to participate or don't contribute enough. Free money, or a way to give yourself a raise. Essentially, employer matches ensure that you are going to receive a 100% return on the retirement savings dollars that you contribute right out of the gate. There is no investment that exists that can promise that. Okay, I know I've talked a lot about matches, and I'll get on to my next 2 reasons to contribute to your 401k in a second. But first, let me say a bit about vesting schedules. This is another item with regards to matches where I see a lot of confusion. When your employer makes a matching contribution to your 401k, it is very likely, actually probable, that their contribution will have a vesting schedule. A vesting schedule simply means that they will require that you work for that company for a minimum length of time before those employer match dollars truly become yours, which is to say, before those dollars become vested. Now, there are a few things to know regarding vesting schedules. First up, they can't be ridiculous. There are rules governing 401ks that provide for what an acceptable vesting schedule can be. Your employer has a few options, but they certainly can't require you to work for the company for decades before that money truly belongs to you. A common vesting schedule is a 2 to 6 year schedule in which 20% of your match becomes vested after 2 years and then an additional 20% each year thereafter. After 6 years, you will be 100% vested. All your matching contributions now belong to you, meaning each match doesn't get its own 6-year schedule. Once you have met the requirements for your company's vesting schedule, every match you have ever received and ever will receive will now be 100% yours. When it comes to vesting, there are two things clients sometimes tell me that either show a misunderstanding of how vesting works or are just, what I feel, a poor argument against taking advantage of your employer's 401k match. The first is, I don't want to make a contribution and then risk losing those dollars because I don't work for the company long enough. This is a misunderstanding of vesting. Vesting does not apply to the dollars that you contribute. Your contribution is a deferral of your salary that you, instead of taking as payment now, choose to contribute to your 401k. That's your money. You earned it. It cannot, just because you chose to put it in your 401k, now be subjected to a vesting schedule. Vesting only applies to employer matching contributions. The second goes along the lines of, I think I'm going to be leaving this company in a year or so, and therefore I will likely lose any matching contributions anyway. Well, maybe, but what if you don't? Putting off making 401k contributions might mean that you find yourself sometime down the line having lost out on matching contributions that you could have been accumulating. That's a poor strategy. Let's talk about reason number 2 to participate in your company's 401k. The second reason to contribute to your 401k is generous contribution limits. Here's a question I get asked all the time. How much should I be saving for retirement? Generally, I don't like to give rule of thumb advice, and therefore I often point out that the answer is dependent on a number of factors, such as how much money do you have saved already, what type of retirement lifestyle do you envision, and so on. However, for the purpose of this video, I'll go with a rule of thumb. I'll explain why in a minute. If you'd like to maintain a retirement lifestyle that is commensurate with what your pre-retirement lifestyle was like, then the pool of retirement savings that you are going to need to reach that goal will likely require you to save approximately 10% of your income over the course of your working years. For every $10 you make, 9 are for now, 1 is for the future. That assumes you begin saving when you get your first professional job, sometime around your early to mid-20s. Now, if you wait a decade and begin your retirement savings when you reach, say, age 35, now your savings percentage to achieve the same goal will probably be closer to 15 to 20%. And if you wait 2 decades, you start saving when you are 45, the savings percentage needed to achieve the same result will be pretty close to about $1.03, about 33% of your income. I did a video demonstrating this some time back. So what does this have to do with contribution limits? Well, you have a number of options for retirement savings. You could use your employer's 401k plan, but you could also use an IRA or a non-qualified account, such as a regular brokerage account. However, there are advantages to using a dedicated retirement account such as a 401k or IRA. These are tax-advantaged accounts, and over the long period of time that saving for retirement takes, using an account that provides a tax advantage can significantly add to the eventual total of your accumulated savings. There are those people that point out some negatives in the tax consequences of a tax-deferred retirement account, and some of these are legitimate. Tax-deferred accounts do not make the taxes go away. They simply delay those taxes to some point in the future. However, I'm generally a skeptic of advice that suggests you shouldn't use a tax-deferred account at all because of some supposed tax Armageddon that is going to happen sometime down the road. Why? Well, predicting taxes is a bit like predicting the weather. We really don't know what the future looks like. The tax code changes at least somewhat every year, and in some years it can change pretty drastically. Of course, you want to be thinking tax efficiency in your retirement savings. However, I would suggest that you simply maintain a mix of accounts, such as some tax-deferred traditional accounts, some Roth savings, and some non-qualified brokerage accounts. They likely all have a place in your retirement plan. However, one indication that the tax benefits in tax-deferred traditional accounts are real is this. The government limits the amount of money that you can put into them, meaning if it weren't a real benefit for taxpayers to be putting money into tax-deferred retirement accounts like traditional 401ks and IRAs, why would the government care how much you could contribute? And this leads to the point of reason number 2. The contribution limit for an IRA account for someone under the age of 50 in 2020, the year I'm making this video, is $6,000. So if you're fresh out of college and your first job pays $50,000 a year and your employer's 401k does not provide a match, then yes, an IRA might be a good option. You can put $5,000 a year into your IRA, the 10% of your income that I just suggested, and you are still under the $6,000 contribution limit. But what's going to happen 5 or 10 years from now? As your income grows as the result of the progression of your career, there is no guarantee that the contribution limit for IRAs is going to also grow to keep up, especially considering you're pretty close to the top of that contribution limit already. The government does adjust the contribution limits for IRAs from time to time, but they don't do it every year, and there is a more than decent chance that it won't keep pace with the increases to your salary. So what does this have to do with 401ks? Well, the contribution limit for a 401k in 2020 isn't $6,000, it's $19,500. And that's just your limit. If your employer does have a match, that doesn't count against that $19,500 amount. Additionally, in making this 401k contribution, you didn't lose the opportunity to also contribute to an IRA. You can still put your $6,000 into that account. If your adjusted gross income doesn't exceed certain limits, you can even make that as a Roth contribution. The third reason I'll give as to why you should likely be participating in your employer's 401k plan is one that's a little harder to quantify, although I think it is possibly the most meaningful. Reason number 3 I will simply call ease of execution. You know, one of the biggest challenges people in my profession often face in working with clients is just getting people to act in getting their retirement savings going. One thing a 401k offers you is easy implementation. To get your 401k savings started, you basically have 2 steps. Step 1, decide how much you are going to contribute. And step 2, choose the funds from those offered by your plan into which you are going to invest. Now, both of those are important, and you should think through your decisions carefully. But once you've done that and put it in place, much of the mechanics involved in making those contributions and purchasing your investment assets will then be automatic. Think about that. Every time you get a paycheck, you will have a contribution going towards your retirement savings, your 401k, and the trades required to purchase the funds into which you have chosen to invest will all happen automatically. There's actually a legitimate investment strategy that you are following by virtue of making these regular automatic contributions along a set timeline. It's called dollar cost averaging, and because of a quirk of math, after some period of time, your average cost for the shares of whichever fund or funds you have chosen to purchase will actually be less than what the average price was for those funds over that same period of time. Dollar cost averaging is a proven strategy that some professional investors follow, and it's basically just built into the way you will be investing in your 401k as a function of how these plans work. You might ask, couldn't I just do a dollar cost averaging strategy on my own, either using an IRA or a regular brokerage account? Yes, you could. However, it's not going to be as easy. You are going to have to set up transfers and place trades. This is all going to have to be on a disciplined schedule, and you might be subject to some transaction costs or a charge for purchasing this or that mutual fund. Most, if not all of that, is eliminated when you participate in a 401k. So does all this mean that 401ks are perfect and there are absolutely no downsides? No, not at all. Of course, like all things investing and financial planning, 401ks have their strengths and weaknesses. One notable weakness is your 401k is likely going to limit your investment options, and the funds you have to choose from might not have been your first choices had the world been your oyster and you could select from any of the literally thousands of funds that are commonly available at a broker. And 401ks have to be managed. Sometimes the fact that they are so easy and convenient means that people tend to set them and forget them. They never go back and reassess as to whether the investment choices that they made several years ago are still appropriate for where they are in their life stage now. For this reason, in managing your 401k, I would highly encourage you to speak with a financial professional, someone who hopefully has the letters CFP with the registered trademark sign following his or her name. I'm Jeff Drayton. Thanks for watching. everyone, nothing in this video is meant to be specific advice for you. Advice like that can only be had by working with a financial planner who knows you and your situation. If you'd like to speak to somebody from my firm, I would encourage you to visit my website at www.jeffreyadrayton.com or email us at info@jeffreyadrayton.com. When seeking advice, I would encourage you to work with someone who is a certified financial planner. This is signified by the letter CFP with the registered trademark sign following his or her name. I would also encourage you to work with a fee-only financial planner. Now that's two words, fee-only, not fee-based and not fee plus commission. Both of those terms mean that the planner or advisor can receive commissions and is therefore not free of the conflict of interest inherent to commission sales. Again, I'm Jeff Drayton. Thanks for watching.